Well, it looks like everybody's here. Welcome to
Hey,
Investing with Sasha, but everybody's here but Sasha.
yeah, looks like we're all here.
We're all here.
Okay, we're on the show.
I have a special guest, Milan. Welcome to the show. I'm glad to have you here. I guess you're a special guest, so if you can just give us a little bit about yourself, who you are, where you're from, what you do, and that'll be a good start.
Well, I'll do that. But before I do that, I want to ask you, does your audience know that Sasha is a chess expert?
Oh, yes. They
Oh,
should
yeah,
know
of
that.
course. He never tells us otherwise. He actually does a chess show. So
Does your audience know that he is a music expert?
Yes, as a matter of fact, we're actually going to we're planning to do a music show with him at Duke University. So that's part of the plan. And I used to be good too. I was 3-time Florida State chess champion and a USCF master. So I played a little bit of chess in my younger days.
I say
not a bad player.
I'm fond of saying that I would be happy to spend a year in jail if there was another chess player there with me.
Oh, really? Well, that's because you could play chess all the time.
Yeah, there's Sasha.
There's
Hello.
Sasha.
I had to restart my smartphone, so
yeah, you're on your
working.
smartphone.
It's great.
Right.
So,
well, we started on time because
it's great.
All right, so let's focus on investments because we have half an
There
hour.
we go. Yeah, right.
Okay, let's see. First, let me tell you that I first met Sasha this past weekend here in Collingwood. We had a chess tournament, and Sasha won his tournament, his section, and then he and his wife came over for dinner, and he played the violin not too badly. Then he played the piano superbly, and so the man is a genius, and you probably know that. And the only person who might be a greater genius than Sasha is his wife, Nava, who was also there and who also won her part in the chess tournament. So now I'm by myself. I'm a retired dentist. Retirement is the leading cause of death, so I want death to be my retirement. So what I do now, since I don't practice dentistry anymore, is I've been a stock market investor for 50 years plus. When I came to Collingwood in 1965, I befriended a lawyer who was personally and professionally involved with the stock market. And we were both single, and we double dated, and we played chess together, and we went fishing together, did everything together. And he got me started in investing about 50 years ago. So I have no qualifications except experience. I have made every mistake imaginable, including some original ones. And so what I want to do is I have a debt to society. I am a newcomer to Canada. Canada has treated me well. All of you are either newcomers or 2-3 generations ago. And so your parents were newcomers. We have done well in this country. And I feel good about being able to do something by helping people avoid the mistakes that I've made. So shall I start talking about investing now?
Yeah, it's about time.
Okay. Now, we talk about habits which result in better performance, investment performance, than over 95% of portfolios over an extended period of time. Extended period means peak to trough to peak. And the 6 habits are, I'll first enumerate them, and then I will go into some detail about them. And your audience, get your pen ready, or you can replay this video later. Number 1 is save. Without that, the other 5 don't work. Number 2 is do it yourself. Number 3 is buy the American market as a whole. That is, don't pick stocks. Number 4 is buy and hold. Buy and hold. Number 5 is an adjustment to number 4, which is rebalance to your personal asset allocation when market movement, either up or down, requires you to do that. And number 6 is avoid complexity. Now, let me go into those 6 points in detail. First of all, I'll tell you that every mistake that any investor ever made is a result of ignoring one or more of these 6 habits. So the first one, save, is obvious. And the earlier people start, the smaller percentage of their earnings they need to save. So if somebody starts a job, middle 20s, and they save 10% of their income, by the time they get to be 65, they will be able to maintain their lifestyle in retirement with that sort of saving approach. Now, if they put it off until they're in their 30s, they need to save a higher percentage. By the time they get into their 40s, if they haven't started saving and they start saving into their 40s, they nearly have to put away a half of their income. So interestingly, the American Dental Association published a paper a while ago showing that over 90% of dentists cannot afford to retire at age 65 and maintain their lifestyle. And dentists are some of the highest earning people, both in Canada and the United States. So the problem is they are ignoring one of the 6 habits. So the first one is save. The second one is do it yourself. Yes, there is a place for financial advisors and managers, and there are a lot of people who are not interested in doing this, and they're widows and orphans, and they need help. But doing it yourself is a simple thing. And when I talk to my colleagues and we do Zoom meetings, I tell them at the end of this program, you will be able to teach a high school student how to equal the market over an extended period. And your audience will be able to do that as well. So number 3 is buy the American market as a whole. No stock picking. How do you buy the American market as a whole? You put your money into an exchange traded fund which tracks the S&P 500. The S&P 500 is a pretty good approximation, a representation rather, of the American market as a whole. That's number 3. Number 4 is don't trade, buy and hold. Number 5 is a modification of number 4, which is do, buy, or sell if your asset allocation is disturbed by market movement, either up or down. And number 6 is avoid complexity. If somebody offers you an investment which you cannot explain to a 12-year-old, stay away from it. So those are the 6 habits, and people practicing those 6 habits can manage a portfolio of a couple of $1 million or $10 million or more in 15 minutes a week. We do surveys of our members, and so our program, Monday Morning Millionaire, we publish something 2, 3, 4 times a week, and we do a survey once every second week. And we asked our members how much time they spend managing their portfolios. And most of our members, or many of our members, are either retired or close to being retired. So they're looking at portfolios somewhere between $2 to $5 million. And most of them spend 15 minutes a week managing their portfolios. Some of them spend 10 hours a day because they enjoy it, which is okay. It will not improve their performance. That's guaranteed. And so that's the sum of it. And I can expand on any of these that you want me to, but that's all that it takes. And so if you take a look at what's published about investing in any one day, any 1 hour, plus the talk shows such as this one, if people take a look at what appears in one day, it would take them a month to digest it all. And their performance would be no better than buying and holding the American economy as a whole by buying an exchange-traded fund which tracks the S&P 500. An example would be SPY. So David Swenson, who managed the Yale portfolio and did very well, he did much better than the endowment funds of any other universities, said that over an extended period of time, which is peak to trough to peak, there is close to 0% chance that an investor will outperform an index fund as represented by an exchange-traded fund which tracks the S&P 500.
So Milan, I have some comments that first of all, everything you're saying is either mostly correct. You're correct. There's no doubt. You couldn't even challenge many of the things you said. Saving is fabulous. Buy and hold is good, but I guess if you're holding an exchange fund, and the main thing is if you're not, panicking, so that makes sense. Rebalancing by allocation, can't argue with that. Avoiding complexity, yes, generally. But here's where I would challenge what you're saying, possibly.
Glad to hear you. Go ahead, challenge, Peter.
I mean, but it is, first of all, based on the past, everything you're saying is absolutely true. The average investor hasn't done well. They tend to underperform the market, as mutual funds do and as brokerage recommendations do. So, and many people have suggested, the idea of, an ETF. And I do like the idea of America over other countries more than ever now, for many reasons, because of our energy independence relative to other countries, even though we're not independent anymore. But okay, but here's where it might work and it might not. And I believe I've outperformed the market by far. And I'm pretty certain Sasha has outperformed the market by far. But it's hard to find good advice in this market. But so I'll go back a moment and say 20 years ago or so, I read an article that influenced my investing tremendously, which was it was in Barron's, and it said that over 1,000 years there was a correlation in the markets. And you say, how can you get 1,000 years of market history? Well, they took the United States, they took England, and they took Japan, and combined that was about 1,000 years. And what they found was that almost a one-to-one correlation with this. When the population over 50 was growing, I'm sorry, I'll start the other way. When the population under 50 was growing relative to the population over 50, the markets went up. When the population over 50 was growing relative to the population under 50, the market went down. Now, and that was almost a perfect correlation. And it makes a lot of sense in a way, because as you get an aging population, as we have in many countries around the world, people tend to spend down their assets. And as a matter of fact, I think a lot of Americans have well underplanned. A lot of people took Social Security at 62, 2/3 did, and many people have not accounted for inflation and other things. So, but the point is the second thing I'd say is, well, the market's done very well in the last 20 years. That doesn't work. But except for one thing, the Fed put. So the Fed has been lowering rates, lower and lower and lower. And the market's been going up, even though the population over 50. It's almost a one-to-one correlation. But the only thing that broke that was the Fed lowering rates. Except for once you get to almost zero, which we've been at, like Japan, things stagnate. So, a lot of brokers also, by the way, I'll throw in, are saying they expect very low returns for the next 10 years. So that said, it's not easy. But taking the whole market may be very risky, especially right now, because I think we're in a very dangerous area with inflation and stagflation. And that may be a real disaster right now for that formula.
May I also add something? I'll just add one thing. I totally agree with you, Neil, on overall approach. But I would even add that some people may feel that by buying S&P 500, which is all American company, you may miss some opportunities overseas, maybe China, India, maybe some other countries. But it's not true, because most of this S&P 500 companies, they do a lot of business overseas. Right. So you're capturing not only essence of American business, but world business. Basically, it's on your plate.
Right.
The Economist, no less a publication than The Economist, stated that you cannot trust Chinese numbers.
True.
And so the American economy, all these companies have a presence in every country. So they're represented everywhere.
or they have to they
You,
do direct business,
Peter,
or their suppliers in overseas somewhere or so on. So it's all interconnected, and I think you have
yeah,
a good
yeah.
coverage of world economy through S&P 500
Now,
approach.
Peter, you've heard of SPIVA, SPIVA? S,
Not
S,
particularly.
Um, let me recommend this to your audiences. You know, one time I was invited by 10 ladies for lunch to talk to them about various things. And I love having lunch with 10 ladies. I was the only man there. And so I asked them, how many of you use Google? Everybody. How many of you use Google Scholar? Nobody. Now, Google Scholar publishes peer reviewed papers of the first order on any subject that interests us. So if we go there and check for SPIVA, SPIVA, which stands for Standard and Poor's versus Active Investing. And very few over the course of a market cycle, peak to trough to peak, can equal owning the S&P 500 or an exchange traded fund which tracks it, index investing. So
Yeah, the odds are with you. I know that. And also because remember a lot of these funds, if you're talking about funds, they have the charges and that's if you just stick it in a mutual fund rather than in a low ETF, you have to pay the
oh,
charges.
the hidden costs that Wall Street has, the
Mhm.
list is very long.
It is.
Now, I'm going to ask your audience, I'm going to ask you, suppose that you knew that there was a 50% chance of an accident if you went driving. Would you take a drive? Would you drive knowing that there's a 50% chance of an
No,
accident?
that's
No.
easy. You would
No,
not.
you would not. Okay, now, when you buy a security, you are buying it from somebody who is selling it. Both of you cannot be right. If the security goes up, the buyer is right, the seller is wrong. If the security goes down, the buyer is wrong, the seller is right. A mathematical certainty, a 50% chance of an accident. That's why we discourage people buying individual securities, because that happens all the time. Collectively.
Wait, Milan. Let me ask you a question then, though. If I buy the S&P 500, somebody is selling the S&P 500. So isn't that
Good point. Good point. I have to think about that one.
Well,
That's right. Yeah.
well, the thing is, the study that I read is that it's very important, more important, the asset class you're in rather than the individual issue that you're in. One
No,
asset
yeah,
class that's
yeah,
come on
yeah.
our show even today is cryptocurrency.
oh
Now,
my gosh.
this group is pretty much a bear on cryptocurrency. But Milan, since you're new to the group, what are your thoughts on cryptocurrency as an investment or an asset class?
There are about 18,000 cryptocurrencies out there. And I'm going to pick the correct one. Hello. And so, also, I could not explain cryptocurrency to a 12-year-old.
Correct. Right.
So that 6 point, they avoid complexity, applies to cryptocurrencies. So,
Right. Yeah. Well, I mean, for a lot of different reasons, we're very bearish on the cryptocurrency, and I saw because a lot of it is the enthusiasm. Oh, it's cryptocurrency, blockchain, and the other thing is we saw that with the .com boom in the
yeah,
early 2000s.
exactly.
All these people invested in .com, and Dr. Milan, it all just went bust. And so the thing is, I don't think
Yeah.
that was a great place for asset allocation. Now, I'm pretty simplistic on individual stock investing because I have some professionally managed for the reason I just don't want to bother with it, let someone else mess with it. Some I trade with. And my thoughts are always you want to buy low, sell high, especially on the 52-week high low. Now, it doesn't work all the time, but generally when you buy anything on the low and you sell it on the high, you're generally better off.
I disagree with you, Nick. It works
Sure.
all the time. So,
It does work if you buy low and sell
our
high.
members do. We don't pick
Right.
individual stocks because there's a 50% chance of an accident. So
Mhm.
we buy an index fund that tracks the strongest economy in history.
Sure.
And we rebalance to our asset allocation.
Yeah.
Rebalancing to an asset allocation of about, let's say, 50-50. That's the asset allocation that John Bogle personally had, and he was the man who promoted the idea that I am.
Yeah, I'm familiar with John Bogle. I had a friend of mine who was a good friend of his. Yes.
So he had a 50-50
Vanguard.
asset allocation. So
Mhm.
Warren Buffett one of the greatest investors in history, wants the money that he is leaving to his wife invested exactly the same way as we're talking about over here.
Right.
If it's good enough for Warren Buffett and John Bogle, it's good enough for any of our members there at Monday Morning Millionaire.
Yeah.
So I don't agree with you about the most difficult aspect of the 6 habits is the first one, saving. Because we usually buy more house than we need, and we usually buy more car than we need. So saving is a difficult thing for most people. But once they get that habit of saving under all circumstances, they're going to wind up okay. So now, because we rebalance to our asset allocation, and let's say a 50-50 asset allocation worked for John Bogle, and 60-40 also works, and 40-60 also works. The differences are not huge. What happens in asset allocation when the market goes up, we take profits and put it back into the cash part.
Mhm.
When the market goes down, we take cash and buy bargains. It
Sure.
always works. You're
When you
always
say
buying
cash, you
bargains.
mean including bonds, right? Or
Bonds. When
because
it
you'd have
comes
an
to,
allocation to bonds too under your system.
well, we have an interest perspective. Our perspective on bonds is we don't even know how to spell the word. Because the bond market, by the way, is larger than the stock market. And the reason for that is that, first of all, the reason why we don't know how to spell the word is that after taxation and inflation, holding bonds is almost always a losing proposition. So
Against
in
inflation.
tax exempt applications such as pension funds, let's say, and university endowments and operas and orchestras and so on, which are churches, tax exempt, buying bonds works. But for most individual investors, it's
Well,
almost
there's
always.
muni bonds and there's bonds inside an IRA, and I mean, well, a lot of people think. I mean, so you're saying that you would put whatever allocation you have, let's say 40% cash, and just sitting in cash, earning almost nothing.
You can put it in money markets, though.
Money
Yeah, that's what I'm saying. Okay,
Yeah.
so that's your system.
Money markets give a very low return. And recently in Canada, and not so in the States, we have guaranteed income certificate, GICs, which
Yeah,
are
good.
now paying more than they have for years and years and years, depending on how
Yeah.
long you're going to hold it. And they just started a couple of weeks ago. GICs make some sense. But the idea there is to keep our powder dry and not to earn anything on that cash section. That's called cash drag. Everything that's in cash is dragging the portfolio back. But
Right.
when the market drops, let's say 10%, listen to this. A very successful investor that I know of recommended this as an asset allocation. He says 50-50. The market drops 10%, put half of your cash in it. Drops another 10%, put all of your cash in it.
Wow.
Drops another 10%, borrow. Now, no financial advisor would advise
May
you
not be
to
a bad
borrow,
idea.
and you don't need to do that to prosper. You can do
Yeah.
it simply by
That again, that's in the past that was all true. But what if we're heading for an environment? What if we're in an environment right now where the market's been going up because the Fed has been reducing rates, but now inflation is forcing the Fed to raise rates, and we're heading for a long period of stagflation. I wouldn't be touching I wouldn't be touching more than half the industries in the S&P. I've been selling. I just sold most of my consumer staples XLP. In disclosure, I wanted to say that at the show. I sold Juan, which is a fertilizer company. I sold GLW. I made very nice profits. Some of them short term,
congratulations,
very large. But
congratulations in the
what I'm
long
saying
run.
is,
And
you don't know this because you haven't watched the show, but I've been very bullish on energy for a year now, much before the market, and I'm still extremely bullish for energy. We may be heading for a situation where oil goes over $200 a barrel within the next year, and natural gas we're in short supply. This is a world-changing event, and that was before Ukraine, and so the markets, consumer discretion. Look, we're in an environment now with 8% inflation, and nobody knows how long that's going to last. Now, Larry Kudlow and Larry Summers, who are on opposite sides of the fence, are saying the rates have to go to 6% to calm inflation. Kevin Hassett, who is very successful economic advisor for President Trump today, I heard him saying he thinks rates have to go to the inflation rate. Now, to tame inflation. If rates go this way, or if they don't, I'm afraid we're heading for a major recession. And here's why.
Right.
Because if they don't tame inflation, it's going to crush the consumer. And we're largely a consumer-based society right now.
Yeah.
So we're 2/3 service, and people are, credit card debt is going through the roof right now. People are maintaining lifestyle, but that won't last long. But if you have 8% inflation, 8% inflation, 8% inflation, and some people are arguing it's going to go even higher now, it's going to eat away. And so what industry, if you're in the S&P, you're in an industry. And by the way, another very important thing is, and again, I don't totally disagree with you, but here's another important thing. The S&P 20 years ago is not the S&P today.
Mhm.
That's true.
Tech,
Yep, different.
very few percentage of companies make up the bulk. I think it's 25, 30%. We're talking about Microsoft, Google, Amazon, Facebook, some of them may be in the QQQs, but these big tech companies, by the way, many of which I've been getting out of in the last 3 months.
By the way, none of those are in the S&P 500. They're all in NASDAQ.
I know. Oh,
they're all on NASDAQ. None of them are in the S&P.
I know tech is a large part of the S&P 500.
They're part of the S&P, but they're part of the NASDAQ also, because that's
okay. No,
they are part of the S&P.
They're part of the S&P. They're just traded on the NASDAQ as opposed to somewhere traded on the New York Stock Exchange.
Right.
But Peter, remember the S&P booted out Exxon. I mean, that was a big one. And so why would they? I think that was a mistake. I know, but so the S&P is a manipulated number to begin with because they change who's in the S&P 500. So when you watch it, you're watching a manipulated number. Now, when you do your own individual, and here's the problem I have with the professional managers, and I work with about 300 to 500 million. My real job is I manage about 300 to 500 million in pension plans. My fun job is I go on the show. One of the things you have a problem working with these money managers, and even the ones I do, is once they put you into the market, they never get you out of the market. So, in other words, because they make money on asset under management fees. As my friend Max, who manages about 100 million individually, in addition to our fund, said, well, the market's down, I still make money because the asset manager makes a percentage of assets, even if the client loses money. Okay. And according to him, FINRA says that's the way it has to be. Otherwise, it's rebating. So what happens if you put your money with Fisher Investments, which I think David Walker, who's on our show a lot, former Comptroller General of the United States, he goes, it didn't work for him. He just goes, it didn't work for him. But it works for always is Fisher Investments, because they make money whether you make money or you lose money. You lose money, they still make money.
The answer is clearly not to go with the brokerage. But Nick makes another good point, which is a lot of these index funds, their reporting is like if you look at the S&P 500, it's very slanted because let's say a company goes bankrupt or is failing, they'll pull them out of there.
They pull them out and put another one in.
Then they look at the current S&P 500 and they say, oh, look, these 500 companies did really well, but they don't look back and say, what about the company they threw out? And
they don't do that.
It's like, that one's gone, but
there was a very interesting.
You did own it at one point.
there was an interesting study that came out today with Kathy Wood's ARC, which we've been following, versus the S&P 500 and Warren Buffett's Berkshire Hathaway fund. Today, they're equal. But if you saw what happened, she had this big run up in the market, and then she had a big crash.
That's right.
And this goes back to the timing. Like, this is the reason why I'm listening to Sasha. Sasha told me about a month or so, get out of the market, go to cash. So I went to cash. I was going like, how would he know? And then, of course, the market went down. Now I come back on the show. I said, Sasha, when should I get back into the market? Because even though it fell 16% this year,
My opinion is that the market right now is looking
down another 10%.
Market right now is looking for the bottom, but can't find it yet. So until it will find, when all the meme stocks and all this high-tech little stocks like I don't want to call the names not to make people unhappy. They have to fall as much so people will throw the towel. They have to close accounts. They have to sell everything what they have. Some people have to jump from the 20th floor of their towers. It's just not there. The capitulation is not there until there will be total capitulation where everyone will be out of the market. Get out.
Yeah.
Oh no, you want to say, oh, that guy is he's still holding some stocks. Let hammer the guy over the head. Oh, he sold. That guy sold already, and the other guy already, and that guy got margin call and couldn't pay on time. You know, all markets these days, I'm following sometimes what's
It's going to
happening.
be a long
They all
process.
going down in the morning, and then around 1 o'clock they start trying to get a little bit higher. You know why? Because the margin calls have to be paid by 1 o'clock.
You know,
So
Martin,
once
Sasha, you just gave me an idea, and I agree with you. You know about the direction. I wouldn't. You know, I'm not even out of the market. I'm 50% bonds though, and I don't care because I've been buying bonds at over 3%, munis around 3. And I'm going. You know what? I think this is a historic opportunity. Although maybe it'll go to 4, but I don't care because the bonds will be there. You know, and I had a much lower. I had a large cash allocation, but I'm going. I personally think in 5 years, 10 years, interest rates are going to be at 0. The economy is going to look like hell, and there's 10 different reasons why. But number one is the government's going to owe so much money they're going to need rates to be 0 in order to control the huge debt. Medicare is going under in 22, 4 or 26. But what you were saying, Sasha, is maybe it'll be a slower process and not one day because people have been taught for 20, 30 years, buy the dips. You know, the market is always good. You know, hang in there until it goes back. Don't sell and, you know, panic. But what if we're in a, you know, then maybe we're in a gradual decline anyway.
Okay, remember
I
2008.
disagree with you. I disagree with you because before, like even 10, 20 years ago, when you got margin call, you had 3 or sometimes days or a week to pay your margin call. Now, you know, I've said many times in the show, when you get a margin call, never pay it. Sell whatever you hold, but don't ever pay a margin call. Okay. Rule number 1, it's something to do with the preservation of capital, which is the most important thing in the market. Okay. So in a previous time, 20 years ago or so, you had a week. Then you could call your broker and say that you're waiting for money transfer from Russia or Philippines or somewhere else, and it's already almost there, but it will be there in 2 days. So broker would give you another 2 days. Your stock would go even lower in these 2 days, but it doesn't matter. So eventually he will sell you out. It doesn't matter. So this today,
what you're
it's all
saying is you
paid
think there will be a big
in
panic
1 day. You got margin call, you have to pay next day by 1 o'clock. The end of story.
I am your
I
guest.
think this day it will be faster.
Sasha, I'm your guest here, and I haven't had a chance to say anything for
Please
the last
do.
little while. So please give me a
Go
chance.
ahead.
Now, first of all, the S&P 500 was founded, I think, in 1957, and there's hardly any security on there in 1957 that's there today. So it does change. Now, listen to what Confucius said. Confucius said, study the past if you will understand the future. So Reinhardt and Rogoff wrote a book, I don't know, 20, 30 years ago, highly regarded book called It's Different This Time, arguing that it's not different this time. But there has never been so much money in circulation as there is now. Before the pandemic, the average American could not write a check for $400. Then he started receiving $1,400 a month. And all that, then he couldn't spend the money because he couldn't go anywhere. He couldn't go to baseball games, couldn't go anywhere where crowds gather, couldn't go to restaurants. So he wound up with a lot of money. Whereas some of that money is getting into the stock market. A lot of that money is getting into the stock market. The market has not done well in the last little while, but certainly since the year 2007, 2008, it's been almost a straight up when people started investing. So study the past if you will understand the future. There's a very good chance that things are going to continue that way. Now, you asked me, I think, Peter, if I'm buying the S&P 500, somebody is selling it, will both of us be right? Good question. But the somebody who is selling it might be selling it to buy groceries and pay the rent, because people live off their portfolios. Many investors live off their portfolios. So if all they have is the S&P 500 and cash or near cash, which is what we recommend, they have to sell, either take some of their cash or sell the S&P 500 to buy groceries and pay the rent. So both are
I
correct.
would add to that proposition is that we forgot about time horizon of each investor. Somebody who is buying S&P today maybe has time horizon of 30 years, and
Yeah.
somebody who sells maybe have horizon of hour and a half. So he bought S&P in the morning, the market is going down, he sells. Or somebody bought it a year ago, its market went down quite tremendously, so he must sell. So
Sasha,
its time horizon is very important on a market.
true what
Well,
you're
you know
saying.
what, Milan, let me say this, what you just said, which is true. People may need to buy groceries and rent or fill their car up with gasoline. But 2 points. In the short run, a lot of people are going to have to pay a lot more for groceries and rent and water, but also, and other expenses. But also, in the long run, you've got a huge population of people. As a matter of fact, I saw a study, which I was going to bring up in the next show, but it's about people with pension plans, traditional DB plans, defined benefit plans, versus people who have now 401ks. And the prior generations had DB plans, many of them, and government workers still do, where you get a steady cash flow. But now a lot of investors have 401k plans where, the millennials and the boomers. And the study showed that among the people who have 401k plans, unlike the people who have DB plans, but this is the boomers who are now retiring, um, they forecast that half the people would run out of money at age 85 who retire, thinking they're all set. So, and this was without huge inflation. So, with inflation eating away, possibly for years now, what if we get 10 years of inflation? All of a sudden, people are like, I can't afford to lose my money. And people I've never experienced this. I'm losing money in the market. I'd rather at least preserve my capital and go to cash. So, this may be a new cycle we're in for the next decades, with all those people retiring, with people needing to live on their money. And
Okay.
I'm not sure of anything. You know what? In the end, I'm a bottom up investor. I find great investments, and that I think with good income or a good options situation from Sasha. And
Money,
you know what? We're starting to run out of time. We always end the show, and maybe you come back on because it's been interesting.
Absolutely. We haven't touched almost anything. We have not talked about
No.
options. We have not talked about high yield dividend stocks. But I want to tell you some
I
fun.
wanted to just throw my dividend stock in there, Sasha, for the week.
Oh,
but
yeah. Okay.
I'm very excited about it.
Well, we will. Okay, Peter, go ahead with
Just
you.
real quick. So I went from 9% to 11%, which is a very high allocation. I don't do this too often on Slate Grocery REIT. And I've mentioned this before, but it went down, but I was going to buy it even higher. So it's a Canadian company which owns U.S. stocks. So this is why it's not very well followed by the markets in general. It's got a large number, I forgot how many, but 80, 90 shopping centers. They're open air shopping centers, which is the best place to be, much better than malls. There are 100% or very close to 100% grocery centered shopping centers. And grocery shopping centers are very safe assets. And if you go local to your local grocery, we have groceries. And when I travel, I go, you always see these. Anywhere there's a grocer, people want to be near it because of the location. As a matter of so it's paying an 8% dividend right now. And I've been a long time holder, but I sold some at 14, but now it's down to about 11 or 10 and a half. And I just said, I was just waiting for the opportunity to buy more. So I listened to their conference call, and the CEO, I think it was, made an important point. He said, occupancy at open air grocery oriented shopping centers has been over 90% decade after decade. So unless we get to an inflationary environment, which is just crushes everything, I mean, beyond belief, which is why I'm 30% oil oriented anyway. I mean, the MLPs, pipelines. And I have a lot of new information about that for next year. But it's like, I'll take my 8%. And their AFO, by the way, grew 15% last year over year. So they're covering their dividend. They also made very accretive purchases during the COVID, and those are increasing very dramatically. The ones they took over. So it's a very safe investment. And now I'm 50% bonds, roughly, at least for now, and maybe for the long run. And the other part, I'm mostly energy. But if I'm going to try something where I'm willing to take some risk, this is where I'm willing to take it with 10% of my portfolio.
If interest
I like to have fun.
SRRTF, Slate Grocery REIT.
If interest rates go up, what's going to happen to bond values? Guaranteed fall in bond values, isn't it?
Well, 2 points. One, in the end, since I don't buy mutual funds, I buy bonds. When my bonds mature, I'll get my money back.
Oh,
And
that's
in
true.
a worst case, I'll get 3% tax-free on a muni, roughly, or 3% in an IRA, instead of getting, and maybe if rates go up, then maybe I would have gotten 4 or 5. But if the economy goes where I think it's going to go in the next year, 2 years, 3 years, the Fed is not going to be able to keep rates up this high. Inflation or the Fed, either one, is going to crush the economy. We're going to have a recession. And then in the end, the government's going to need rates to go to zero in the next few years anyway, because of the huge debt around the world, by the way, other countries too. So those bonds could be, by the way, I'll throw one last point. And this is just an interesting point.
Two important things we haven't mentioned. One is money that we're going to need in the next 2 to 3 to 5 years to buy groceries, pay the rent, buy a car, take a holiday. Money that we're going to need in the next few years does not belong in the market. The other one is the time frame that Sasha referred to. Some people might have 30 years, some people might have 30 minutes. Actually, we all have a long time, because people who have 30 minutes will leave an estate if they invest properly, and that estate could last for years and years and years. So that's short time. And then you talked about
I'm afraid their estates will last much longer. Their estates will last much longer than their money, I'm afraid. But I want to tell you some interesting story, because I myself, as you see, the CNBC is on background, and a lot of investors, long-term investors, half-an-hour investors, they all watching CNBC, most of them. So there are interesting thing I noticed. Just a while ago, 2-3 months ago, there are a lot of commentators who were talking about high-tech stocks. And one would say, oh, look at the stock Roblex, RBLX. Oh, it's a fantastic story. Stock is only $110, but it's going to 120 almost any time. And another commentator says, well, actually, that stock is going to be in a few months $180 a share. Another says, no, it's going to be $200 a share. Well, today you can pick it up for $23, and nobody's talking about it anymore. What's happened?
Don't pick individual stocks. High tech is the place to be in today. In the end of the 19th century, the place to be in was automobiles. Yep. There were 2,000 automobile companies. By 2008, there were 3 left. 2 of them went bankrupt. Could you have picked the Ford Motor Company at the end of the 19th century? So high tech today is the place to be. Could you pick out the Ford Motor Company equivalent of high tech today? No, you can't. Don't buy individual stocks is what we recommend. Then
absolutely. Well, I don't know if Roblox is making S&P 500. I would be very curious if it does. So maybe that contributes to this fall.
Well, we can do another show on high tech for sure.
We'll do. Listen, in the meantime, I would like to thank everybody to being on this show and your fantastic debut, Milan. And I hope next Wednesday we'll get all together. I think I figured out my technical problem, and hopefully it's not going to happen. And in that case, have a great, fantastic week, successful investment, and I'll see you next Wednesday. Thank you very much.
About derivatives. Let's talk about
derivatives. We can talk about derivatives.
We'll talk about everything. That's why we have next show.
Thank you.